ladies and gentlemen. Hello and welcome to the Value Line Series One Stock to Buy Right Now webinar. With that, we invite you to sit back, relax, and enjoy today's presentation. I would now like to turn the call over to your speaker for today. He is the Director of Research, Mr. Ian Gendler. Mr. Gendler, you have the floor.
Today, using Value Line's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on ValueLine.com and our YouTube channel within the next 48 hours. Lastly, as an added bonus, attendees will have the opportunity to receive an additional stock recommendation. I will provide details at the end of the presentation. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As a jumping-off point for our stock search, let's start with an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. The economic picture is evolving. 3 months ago, the nation could look back at a solid 2018 business breakout, having completed 2 of the best quarters in this long but understated expansion, with second and third quarter gross domestic product growth of 4.2% and 3.4% respectively. Also, forecasts were upbeat for the final 3 months of 2018, with GDP growth of close to 3% expected. However, the start of a partial government shutdown, a faltering in business offshore, a further standoff with China, a likely fourth quarter slowdown in business inventory investment due to the trade uncertainties, and a surprise decline in late-year retail sales would dent expectations meaningfully. True, we did see some improvement in our overall trade position in the quarter, as the deficit narrowed in November, and that likely helped shore up the economy somewhat. Still, the expected fourth quarter rise in GDP may have been closer to 2.5% than 3%. Please note that several fourth quarter releases had earlier been delayed by the shutdown. Further deceleration in growth is likely, starting with what could be a sharp first quarter retracement in business output engendered in part by the government shutdown. Of course, the early 2019 story is more than just about events at home. It also reflects an erosion in fundamentals in Europe, where the European Union is reducing its growth expectations for 2019 and 2020, unresolved Brexit issues, and weak economic numbers out of China. Still, with the Federal Reserve suggesting it will be patient, data-driven, and more dovish on interest rates, the early weeks of 2019 have seen a nice rebound in the stock market. That comeback should help underpin consumer confidence and lift incomes and net worth. Then there is the bright employment picture, with January bringing the creation of more than 300,000 jobs and a weaker dollar. The latter should further aid at U.S. exports. All of this is likely to help the economy retain its resilience. On balance, we expect an orderly moderation in output this year, with growth averaging 2.0% to 2.5%, after a difficult start. Consistent with the economy's long march forward and the generally strong profit engine that has accompanied it, the long bull market has been resurgent in 2019. Downward corrections have been brief and widely spaced. The most recent such setback, one of the most severe, took place late last year and was largely interest rate driven. Once the fear of decidedly higher rates passed, as they did earlier this year, the bulls regrouped and turned things around. Add in optimism on the trade front, as progress appears to be at hand on that count, and stocks are gaining aggressively. As we stand now, much of the ground lost down the home stretch of 2018 has been recaptured. Going forward, we sense trade issues will remain front and center and could hold the key to further equity market improvement in the months ahead. Of course, with PE ratios extended again, but with the Fed a willing partner once more, the climb may not be as challenging as one might have suspected a couple of months back. So there would appear adequate justification for a fairly constructive investment posture to be assumed at this time. All told, we think a reasonably good year lies ahead for investors, but there will be challenges. Moreover, sentiment can turn on a dime, as we saw late last year and again in recent weeks. So investors should proceed carefully, with emphasis on quality stocks that will prove resilient in most environments. Harvey Katz, our chief economist, makes a lot of great important points. In addition, he provides a number of details that can be used to create a stock search, and ValueLine provides the tools to complete such a task. Before we get to that, please note that we are currently on our homepage, ValueLine.com. On this page, you can access, free of charge, daily market commentaries and analysis, as well as general interest articles that are written by our research team. Examples of such content are analyses of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. On that note, we are at the tail end of fourth quarter earnings season, so I suggest that you monitor ValueLine.com for data, information, and analysis on reporting companies. I'm now going to sign in with my username and password. After entering my credentials, I'm taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our homepage for our monthly stock selection services, as well as our investor tools. As you know, the point of this presentation is to find a stock to buy right now. So let's go to the screener and get started. Just so you know, this tool can also be found under the Find Ideas tab. Subscribers have access to more than a dozen preset screens, as well as 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. Okay, time to start the search. As mentioned earlier, the market has performed quite well of late, and to quote Harvey Katz, PE ratios are extended again. Each week, on the front cover of the summary index, we publish the median PE ratio for all stocks with earnings in our ValueLine investment survey universe of 1,700 stocks. Presently, that PE is 17.3. For comparison, at the most recent market high, which was reached in September 2018, the PE was 18.2. Let's try to weed out stocks that are trading at lofty and likely unsustainable valuations by utilizing the price-to-earnings ratio field. Please note that our current PE is calculated differently than other sources. At ValueLine, we utilize a combination of actual results and our estimates to calculate this PE. More specifically, at present, our PE includes the 12 months of earnings to September 2019. So that incorporates the recently reported December period and our estimates for the next 3 quarters. We feel that this is the best method for using PEs, but all strategies can work. Just make sure when you are comparing stocks side by side that you are utilizing the same calculation. So I'm going to set the high threshold at 17.3, which as I said earlier, is the median. And I'm going to set the low end to 5. Having a low threshold is important since it will move on profitable companies, firms doing trading on fundamental. This would include companies going in a legal manner, management shakeup, or something similar. And then click Filter. For the next field, I'm going to again tap into Harvey's comments. He mentioned, and I quote, "Sentiment can turn on a dime, as we saw late last year and again in recent weeks. So investors should proceed carefully with emphasis on quality stocks." There are a load of metrics that can be used to assess quality and stability. One that I recommend is ValueLine safety ranks. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. This should be particularly relevant in today's market environment. Thus, let's focus on stocks ranked 1. These are the most financially sound companies, and the stocks have a history of relative stability. It is worth noting that of the nearly 6,000 stocks in our database, only 130 or so garner this top rank. For those that don't know, our safety ranks are derived from our financial strength grades and our price stability scores. For more information on these proprietary metrics, I recommend a read of our ranking system guide, which can be accessed via the investment education section on our site. All right, we're now down to just 31 stocks. Reasonable valuations and risk profiles are crucial, but I also want to isolate stocks that ValueLine expects to outperform the broader market over the near term, and I'm going to utilize our popular and time-tested timeliness ranks. Like safety, the ranks are from 1 to 5, with 1 being our top rank. Ones and twos are expected to outperform the market over the next 6 to 12 months. Threes will likely mirror the market, while 4s and 5s may lag. A great deal of information on the ranking system for timeliness is available in our guide, but I should have mentioned that although the calculation is purely quantitative and proprietary, the system is based on a number of factors, including earnings results and stock price action. So let's add the 1s and 2s to our screen. Okay, 18 results, which is nice and manageable. Let's take a look at the stocks here. To cull the list further, please note that Harvey mentioned that investors should focus on stocks that prove resilient in most environments. As you can see from the list, there are many that can be considered cyclical. Examples are the energy companies, which have struggled greatly of late, several tech names that did not do well in 2018, and banks that may not perform as well if the Fed keeps rates at or near current levels. After reviewing this list earlier today, I think that the Walt Disney Company is the standout, and it is the one stock to buy right now. Before I dive into Disney, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own customized stock report. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. I can also apply those changes to other stocks. I assume you're all familiar with Disney, but let's get some information in regard to what is going on at the House of Mouse. From the commentary module, editorial analyst Orly Seidman recently commented in regard to the company's pursuit of a major acquisition. The Walt Disney Company 21st Century Fox tie-up may be closing soon. To review, Disney proposed to acquire the bulk of Fox's film and television properties last December. The $71.3 billion cash and stock deal has earned shareholder approval and regulatory permissions, but awaits other closing conditions. The company will assume Fox's $19.5 billion debt load as part of the acquisition, and it has already begun to make a tender offer to eliminate some of its outstanding notes. Overall, we are optimistic that this deal will create a powerhouse of branded entertainment. Moreover, we expect the combination will achieve $2 billion in cost synergies by the end of 2021. Even though the companies have had to make certain concessions in light of antitrust authorization, including the planned divestiture of regional sports networks, we think the tie-up will focus on the content library of the combined entertainment assets in order to leverage their combined technologies. Needless to say, this is a major endeavor for Disney, and we are confident that it will add materially to the company's top and bottom lines over the years ahead. Going back to our full report, I want to move just to the right and talk about the projections. I want to highlight that ValueLine is one of very few research houses that provide financial projections 3 to 5 years out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. It is also a ValueLine convention to not include contributions from acquisitions until the deal is officially closed. As such, these figures do not incorporate any of the potential benefits of 21st Century Fox. Even so, Disney is currently priced at around $113, suggesting that there is plenty of upside over the years ahead. I now want to highlight our classic PDF reports, which are available for all digital subscribers. A quick look at the statistical array, or the main meat of the analysis, shows an excellent progression in revenues, earnings, cash flows, etc. Also, going back to our original search, please note Disney's current PE of 13.7. What's more, its median PE, which is the average of the past 10 years, has been 16, and we project that it will be 18 3 to 5 years out. All told, from a PE standpoint, Disney appears nicely undervalued. It is also quite safe and holds worthwhile growth prospects. Disney, ticker DIS, is today's stock to buy right now. This marks the end of the formal presentation, and I will now tackle your questions. Please remember that I will provide information in regard to receiving an additional stock recommendation after the Q&A portion. All right, so give me a few seconds just to see what questions came in. Here's a question about Brexit. How serious is the March 29th Brexit deadline? A deal, no Brexit, an extension. From what I've read, and I get my news on Brexit in the same place as you get, seems like a pretty serious deadline. And Theresa May and the rest of that country seem to be trying to move as fast as they can. I would assume that is a pretty hard deadline. And I don't know what happens if there's no deal by then. What are ValueLine's criteria for start covering new stocks? Okay. Any plans to start covering Buffett's new pick, STNE? Let me start with the criteria. So as most of you probably know, if you're subscribers, we initiate coverage on new stocks almost every week. For instance, this past week, we just added a couple of mid-cap pipeline master limited partnerships. And we're always adding new stocks to replace the ones that get acquired, delisted, go bankrupt, or we drop for very, very small stock prices and things like that. The minimum criteria we look at, and usually it's much higher, but the minimum we look at is a market cap of $250 million, a float of 10 million shares to assure that there's enough market to buy and sell the stock, and typically revenues of at least $50 million a year. Most stocks we add are, the market cap is in the billions. Revenues are easily in the hundreds of millions, but that is the baseline. Simply put, we try to add the largest, most heavily traded stocks. And yes, I did briefly look into STNE the other day, and it is now on the list of potential near-term adds to the survey. Could you touch on why you did not pick AT&T and CVS? Sure. Both are great stocks, and if you've been following this series of webinars, I have recommended and highlighted both of those stocks in the past. So I wanted to pick something different. And I did really like the 21st Century Fox Disney tie-up and the fact that Disney stock looked particularly cheap at the moment. Next question. Explain the cash flow line. Sure. So the cash flow line, which is also commonly known as the value line, is the solid line in our graph, which then goes dotted. That takes a multiple that we choose, and to figure out the multiple, we look at the historical cash flow to price comparison, and then we look at our estimates and target price range, and we try to fit the line, choose a multiple and a line that best fits the stock. One quick way to utilize the cash flow line, if the stock price, the black dot, is currently trading below the line, the stock is undervalued. In turn, if it's trading above the line, it's overvalued. So for Disney, in addition to the PE, on a cash flow basis, it also looks undervalued. Where is the projected PE located? That's in the 3 to 5 year projections column, and it's right there. So it's 18. There's several questions of why I didn't choose some of the other finalists. As I mentioned, AT&T and CVS. Aflac is also another good candidate. I prefer Disney. It's not a knock on the other 17 stocks. In fact, a lot of them look like worthwhile candidates for purchase. Do we consider Disney's plan to enter the digital video streaming market and launch its own service? Yes, we've touched on that in multiple of our recent reports. Obviously, it hasn't come out yet, but I'd be confident that's going to lead to a pretty significant growth driver for the company. As far as content is concerned, you could argue that they have the best content library. Okay. When a timeliness rank moves up to 1, is it too late to get in? Also, is a timeliness rank moving from 1 down to 2 a sell? No on both questions, and I'll expand. When a stock moves up to 1, it then means it is our best selection for the next 6 to 12 months. In turn, when it moves from 1 to 2, we're still very high on it. It's just no longer in the ones. I can tell you from looking at past performance, a lot of investors use the 1s and 2s interchangeably. And year to year, there tend to not be a huge difference in performance overall of the two groups. And as far as, I know there's a couple questions about performance. While we don't often post the performance or publish it, it is available. So if you want to email me, I can send it to you. And my email address is igendler@valueline.com. That's the letter I, Gendler at ValueLine.com. All right, let me see what other questions we got. What are the specific definitions of timeliness, safety, and other ranks? It would take me a little bit to go through it, so I really recommend going to our guide, which I'll take you to under Investment Education, Tools and Guides, the Value Line Ranking System. And there we provide a thorough description of each rank. I have the paper version. Can I access the DIS report now showing online? You can get the PDFs, which I know you already have, but for the bulk of the things that I looked at today, you need a digital subscription. For instance, you wouldn't be able to use the screener. Is having a negative working capital an issue? That's kind of come up a bunch recently. A lot of companies have negative working capital, and even some now have negative shareholders' equity. I don't think it's a big deal. A lot of it stems from share buybacks and just plowing money into operations and capital expenditures and dividends. As long as the company is generating enough cash to fuel all of those things, I don't personally see it as a problem. Obviously, it does throw off certain valuation techniques like price to book value, where a lot of people look at working capital. But on a stock-by-stock basis, I don't think it's an issue. All right, there's a few more questions. There's several questions about the economy. Do you think we're approaching a bear market? Possible recessions in 2020? All of that seems possible. And if you notice, I kept my search for the current year. A lot can happen between now and then. But I do think that there is a chance that there is a recession in 2020 or 2021. Right now, I wouldn't say it's a huge chance. But I think companies like Disney or like the other 17 on that list do stand a good chance of doing well in a down market. Here's another question. How many stocks do individual analysts follow? The number varies widely from just a few to a few dozen. It depends on, obviously, the experience of the analyst, as well as their tenure here, as well as what other tasks they may be doing for us. Obviously, we have people that edit the reports. We have all the model portfolios that some of the analysts manage. So there's a lot of jobs that would impact how many individual reports they cover. Tying into that, though, the analysts tend to cover a number of stocks all in the same industry. So they're experts in those particular industries and sectors. Here's another question about the ranks, and here's a breakdown. For the timeliness ranks, at any one time, there's always 100 ranked ones, 300 ranked twos, approximately 900 ranked threes, 300 ranked fours, and 100 ranked fives. So it's a forced bell curve. So whenever a stock becomes a one, that means the stock is kicked out. All right, I'm going to stop it here. If there's more questions you want to ask, feel free to email me. Like I said, it's Gendler@ValueLine.com. Thank you very much for participating. And as promised, ValueLine is making available an extra recommendation of a stock that you can consider for purchase. It is only available if you call 1-800-ValueLine and press 2 to speak to a ValueLine representative. Please mention code 1902-BONUS. That's 1902 bonus. You will also receive a bonus month of service if you choose to buy or renew any of our annual products. No purchase is required for the bonus recommendation. Well, that wraps it up. I'm Ian Gendler, Director of Research at ValueLine, and thank you very much and have a great day.